What do investors get wrong about private credit risk, and how can they correct it?
The underlying assets, if it is variable, what does it mean for me? Does it work for me or does it work against me? And a smart investor would look, what is the duration of the underlying asset?
What do investors get wrong about private credit risk, and how can they correct it?
Thanks for your question. Most of the investors are entering into the private credit world through some fund, some private fund, or perhaps some quasi like private credit semi-liquid fund they have called it. And I think you are facing three challenges. And this could be your checklist of your personal due diligence when you're looking at a private credit fund. So one is are the returns and how the underlying returns are generated. Secondly is what is the liquidity and how deep is the liquidity. And third are the fees, how the fees are structured. Now let's unpack one by one. So the first one, the returns. The returns in the private credit are determined by the interest rate the private credit manager is charging to the borrowers, and usually in private credit the interest rate is linked to some benchmark like SOFR benchmark in the US, which means that if the Fed, the Federal Reserve System, will increase interest rate or decrease interest rate, also the interest rate the borrowers are paying will change. So that's the first point. So if we all agree that the interest rate seems to be going down, or that's the willingness of the US administration, then the returns on those funds will go down as well. So that's the first kind of due diligence check. Okay, how actually is the interest determined when the underlying assets, if it is variable, what does it mean for me? Does it work for me or does it work against me? Then the fees, I will take it as the second one, is very much connected to this one. The way how the fees are charged will influence very strongly your net return from the investments. So coming back to the interest rate example, when the return is going to go down, it means that the gross return goes down. The net return, which the investor receives, will go down as well. But for how much will go down, if it will be proportionate or will go down more or less, will depend on the structure of the fees. So fees and the funds, usually you have two fees. You have a management fee and then you have a performance fee. These are the two main ones. The management fee is charged from the money which are invested. Usually it's 1%, 1.5%, maybe a little bit less somewhere else. And that's irrespective of the performance. So you're always going to be charged that. The performance fee, however, is a bit more complicated. It is a charge for the returns on the investor. So whatever is made by the investor on top of the management fee, there's some kind of a clip, and typically it's 20%, 15%, maybe some in specialized fund a little bit more, 25% performance fee. And here you could say, okay, then that aligns the interests of the manager and the investor, because okay, the fund is making less money, then the manager is charging less money. But there are things like hurdle rate, for instance, another concept, where you need to check what is the minimum return the manager is giving you, and for that minimum return he's not charging, right? For what is less the minimum return. And if it's like the minimum return is too low, they will still charge a very, very healthy performance fee, irrespectively that the return went less, right? So that's the That's the issue with the fees. And I could go on. There are some games managers play with investors regarding the fees. We could even have a specific episode on this one. So be careful about the fees, because they are a large determinant of your returns.
On the fees still, is there an example of a good way to charge fees? What should you be happy about as an investor when you see a fee structure?
Oh, well, the less fees, the better.
Apart from low fees, yeah.
I think the management fee should be on a reasonable level to cover the cost of running the fund, and then the performance fee should be the one where actually the manager makes money, and they should make money only if the investors make money. So that's the good fee. So it should be
look for true alignment.
Be a reasonable hurdle rate, right, or maybe no hurdle rate at all. There's something which is called a high watermark setting. So if there would be a loss in any given time in the fund, the fund manager needs to build up the profits back, and for the build up of the profits after the loss, he's not charging any fees.
So you essentially don't get charged twice on the same gains.
Exactly. So you don't get charged twice, right? And you will recover faster as an investor. So there's a lot of good practices there. You can always compare the fees of the different managers, and especially institutional investors are very mindful about the fees, and they do look at it. There's something like a trailer fees as well as another topic by itself, where the distributors can be getting paid like by the funds, and there are some good distributors which are saying we are actually not taking these fees, or if we are getting them from the fund manager, we are giving them back to the investor. So fees can be complex. But if I may in the interest of time, go to the liquidity question. There's another very interesting one. So nowadays you hear a lot about semi-liquid private credit funds, and I think you should look under the hood a little bit. What does it mean, the semi-liquid, right? In my honest opinion, when you call a fund a semi-liquid, the underlying assets needs to be somewhat liquid or semi-liquid, which are in the fund. So you need to look at the duration of the loans which are in the funds, and if the duration is relatively short, 90 days, like 3 months, 6 months, right? 24 months, I would say, yeah, you can build a real semi-liquid strategy in this fund, because the fund is generating cash over time, and that's why it has a liquidity to pay back the investors. But often it's not the case. Often it's the case that there are long duration assets over there, maybe 5 years, 3 years plus, and there's some cash level, maybe 5% of the fund is held in a cash, and that's the liquidity for the investors. And that in my view is not like semi-liquid. This is some kind of operational liquidity you want to have.
And that then would become a bit risky, right? I'm guessing if a lot of investors want to exit at the same time, because there's only so much capability.
Exactly, right? And again, a smart investor would look, what is the duration of the underlying asset? What is the limitation on redemptions, and how often can I redeem? And if there would be a highly adverse scenario and then fund would have to be liquidated, how long would it take basically everybody get the money back, right? And if it passes this test, then I would really rightfully put the label, this is a real semi-liquid fund. So in summary, look at the returns, what is under the returns, how the returns are generated. Look at the fees you are paying to the manager, and look at the liquidity of the underlying asset, how actually liquid or non-liquid the fund is, irrespectively the buzzwords which are on the label.
Super, very, very helpful. 3 good tips. Thank you, Radek.
Thank you very much.